that though. Okay, tonight, let's jump right into chapter 5 and 6. We'll pick up where we left off. So I think we're on page 5. Okay, so this is kind of before we actually start doing the audit. We establish an understanding with the client, and they talk about the engagement letter. I'm not going to go into all the details on this. You can look through it. Now, and when you sit for the CPA exam, you'll kind of go through this. This is one of those things that you'd probably go through, you know, the night before or something like that. Basically, it just lays out what you're going to do, limitations, management's responsibility. They have to provide you with all the information you need. Document retention. I don't think we talked about that. Did we talk about document retention? I can't remember. So your work papers, when you're doing an audit, you everything is documented. Everything when you're doing an audit. Every step in the process you document, because you plan out your audit as if you're going to court. So all the work papers that you have, those are documenting everything you did, basically. I think some people find it kind of surprising that when you're doing an audit, about a third of your time is writing. It's documenting stuff. It's not actually going out and finding things. It's documenting what you found. So you'll have all those things that are documented. Now, in the past, if there was some kind of a problem with an audit, CPA firms, and they did this this was actually attempted for the Enron case. If it looked like it was going to be bad, like that they should have caught something, they would destroy all their work papers. You say, why would they do that? Aren't they going to use that in court to show that they, did due diligence? Well, if there is a problem with an audit, it obviously means that they left something out. And what they're trying to do is get what they call a gross incompetence, that it's that they didn't do what they were supposed to do, rather than that they had any intent or that there's other things involved. So destroying the work papers was like, when you a lot of times if something came to light, a fraud or something like that, the auditors during that time, they would destroy everything. Well, that's no longer allowed. Document retention for the AICPA is required to be 5 years. And for the PCAOB, it's 7. And this is kind of close up that legal loophole and really to hold people more accountable for what they, for their audits. All right. So this is kind of an engagement letter, and it's sort of like a mini contract that if we do what we're supposed to do, that you'll pay us, and we give you all the information, timetable, and all this kind of stuff. It's mostly there to limit any possibilities that you have for confusion on it. I had a friend that he taught for us, actually. I used to teach at a college in Orland Park for a while. But anyway, he was a CPA, and he had his own business there. And it was funny. He was talking about, like, he had a client that said, I need to get this audit. The bank said it's a piece of paper. It's some kind of piece of paper that has an audit on it, and he didn't realize like what an audit involved. Oh, and so he said, yeah, I'll take a look at it. And I think he gave a price of something like $12,000. It's just a piece of paper. You just need to, like, oh no, you gotta. We got to look at everything, well, here's my tax records. Here's my bank account. Like, it's not just that, we got to look at, how you document your sales and all this kind of stuff. So anyway, a lot of times that engagement letter will also allow for the client to realize what's going on with an audit, what it entails. Because again, if you never had it done before, it's hard to figure out. Okay, staffing, nothing too crazy there. This one is the one that might seem a little bit out of place. But a lot of times they'll use the internal auditors. So these are employees of the client. This is what I used to do. I was an internal auditor. And we would audit stuff for, I worked for US Steel and for Navistar. And we would go and do audits on, in our own company. And we had a lot of time to do things. And so a lot of times the external auditors would come in, they would use the internal auditors. So it isn't that you never use anyone from the client. Now, if you're using the client's employees, the employees cannot do anything that has to do with judgment. So they would give me stuff to do tests on. One of the things was pensions. Pensions were when I was going through school, I never understood pensions. I think when I took the CPA exam, I memorized it. It didn't make any sense to me. But anyway, later on, I was like, oh, this is so easy. If you're working with something every day. But so they gave me these pensions to do, and I went through and did all the pension calculations. And no, I didn't make any decisions on it. And there was a few discrepancies here and there. To me, I don't think they were very big, but that's not my judgment. You cannot use the employee of the client cannot have anything that involves judgment. They can help with the audit, but they cannot do anything that involves judgment. And everything you do must be able to be replicated anyway. So someone else can go in there and do the same work I did and get the same results. Okay, this one is a little bit interim work for time budget. Notice that you do an audit, for instance, companies will have an audit done for 2024. Okay, and we're already in October. Now you can wait till the end of the year and audit for the entire 12 months prior. Here's the thing, here's the problem with that. Virtually all of your clients are going to be calendar year end, or if they're retail, they're going to be January 31st. But it's a really precious time. The end of the year to up through the first few months, taxes are due, audits are due, all this stuff is busy, 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 busy. So what you'd want to do is try to spread that time out over, if you can, do things that you can do ahead of time, to get comfortable with things and to get comfortable with the numbers for those months that have already passed. So for instance, here we are in October. There's no reason why we can't go in and do testing for the months January through September now, right? Do that testing now. And then at the end of the year, instead of having 12 months to do, we'll only have 3 months to do, right? So a lot of times you do what they call interim work. Okay. First year considerations. If you're wondering why I wiggle my screen, it's because I get this real annoying pop-up that comes up every time I go back to, I do the share screen, and it covers what I'm looking at. Okay, first year considerations. So here we have an income statement. It makes it worse. Let's go back. Okay, so here's our income statement. And we have our sales. This is throughout the year. We have our beginning inventory. Oh, I moved up the spacing. Hold on. It made it worse. Okay, so we have our beginning inventory and our purchases. So we have goods available of 6,200. So that's the most goods we could have sold. We started out with 1,400. We added 48. So there's 6,200 total that we could sell. We go back and count up the inventory at the end. This is the ending inventory. So this is what was not sold. right? This is not sold. I don't know, I put that in there. Okay, and so the cost of goods sold here is 4,100. Okay, now looking at this income statement, we're at year end. Which one of these numbers is going to be really hard to find at year end? Really hard to prove. And I don't mean the ones in, it's not the ones in yellow. The ones in yellow are just the totals. I think I'll narrow it down. Out of these three numbers, which one's going to be the more difficult one to prove at year end? Anyone?
Maybe purchases?
Purchases will probably be second hardest. The most difficult one's going to be the beginning inventory. You know, if you, unless you were at the audit the previous year, this one is going to be the tricky one. This is the one that's going to be hard to, let me get rid of all this other stuff. The beginning inventory is going to be the difficult one. Because unless you were here the previous year, you're not going to be able to get this. You can't jump in the time machine and go back and take the year-end inventory. So the beginning inventory is going to be the most difficult one. Now, notice something about that, though. If you don't know the beginning inventory, you know, what the trickle down is, you don't know the goods available. And if you don't know the goods available, you don't know the cost of goods sold. Oops. And if you don't know that, you don't know the gross margin, you don't know your income. So beginning inventory is a tricky one because it'll have an impact on your net income. And if you can't prove this one out, that means you can't prove out the income. Now, if they did the audit a year in advance, you know, they say, okay, well, we're going to need audit next year. You go, okay, well, I'll come in and do your ending inventory this year. We'll just audit one thing. The ending inventory, you know, they'll become the beginning inventory the following year. So if you planned it, if they were able to plan ahead, that would be fine. But if they actually don't plan ahead, you come in for the first audit, they've never had no one's ever audited their financial statements. That beginning inventory, especially if it's materials, is going to be a problem because it's something, you know, you can't jump in the time machine, go back and verify it. And if you can't verify that, you can't verify the income. So, like I say, if you can plan in advance to maybe come in and do just the inventory the previous year, that would be helpful, and then you can get a clean audit. But if they don't, you can run into a problem with that. So the beginning inventory is fine. So this is a first year consideration if they've never had an audit before. The beginning inventory is a problem. Okay. The audit plan. Everything, I already said this, but everything in auditing is documented. Every single step is documented. And the audit plan has a lot of that documentation. Okay, so the audit plan. It's a high-level description. Everything is described in the audit plan. Oops. You know, what do you do? How do you test this? How do you test all that kind of stuff? And it especially comes down for this. It'll be the audit procedure, risk assessment procedures. Audit procedures is the testing, kind of like our classical sampling and all that, and then other procedures, which we'll talk about. This is chapter 16 stuff, which we will do, but not today. Oops. So risk assessment procedures, how do we, what could go wrong? And then how do we test for those things? Yeah, might as well highlight. We'll underline this one for now. Okay, so risk assessment procedures, what could go wrong? Once we figure out what could go wrong, then we make our test to test for those things. Did they go wrong? So these audit procedures will test for the risks that we identified above. And other procedures. I already told you that I'll put this in again. This is mostly chapter 16 stuff. Okay. So a tentative audit plan is developed based on an auditor's initial risk assessment. Tentative plan may require frequent modifications throughout the audit. Okay, so this is very important, actually. The audit plan is not set in stone. It needs to be flexible to address things that you find. And it could go either way. It could be, when I was doing internal auditing, our audit cycles were usually like 2 or 3 years, usually 3 years. And so you'd have what was a problem last time, and you go, okay, well, we look at this and we'll look at it this time. And you look at it and there's no problems at all with it. So you had this initial audit plan that you're using from based on what you did before. And, there's no problem with this. But then again, something else always pops up. Oh, what about this? Well, we didn't have anything on that last time, and that's completely new. So you'll revise these things, and you revise them. Sometimes it's based on the testing itself. Sometimes you look at the audit risks and you think, okay, we're going to test for these audit risks, and this will be adequate. And sometimes when you start testing, you realize that either there's absolutely no problem with it, or, oh, gee, we have to do more testing in this area. There's these other things that pop up. So it is flexible. It's not set in stone. And by the way, you'll document every change that you do, you'll document. Why did we expand our, the audit of inventory? Well, inventory now, before it was in 2 locations, now it's in 6 locations. And they have a new system in, and whenever there's a new system, the risks go up. So a lot of times, this audit, the audit plan, it's very detailed. However, it needs to be flexible so that when something does come up, we can alter it, and we'll document our audit, the program, and why we did the audit plan, and one doesn't there. So again, it has to be flexible to deal with things that pop up that are unexpected. And virtually every audit I've ever been on, there's something unexpected came up. Okay, let's see. The audit plan has which of the following characteristics? There should be a question mark there, I think. Audit plan has which of the following characteristics? A, it's general in nature. This one's actually no. It's not general. It's specific. A detailed list of audit procedures. What do you think?
Yes.
Yep. Can be changed once the audit is started.
Yes.
Yep. Is based on risk assessments.
Also one yes.
Yep. Is the same for all clients.
No.
Nope. Every client will be different. They're no two. I don't know if I. Well, I'll tell you in a second. It may be changed for revise. It may be changed for revised risk assessments.
Yes.
Yes. Yeah, my wife got a fortune cookie one time that said, "There's no such thing as an ordinary cat." And I love that saying because it has to do with, we're auditing our companies. There's no such thing as a ordinary company. And even two companies that are, for instance, take Target and Walmart. Yeah, they're both retailers. Yeah, they're both huge. They're billions of dollars and all this stuff. They're completely different, and they're run completely differently. They have different market. All these things are different about them. They're even though they're two giant retailers, they're not going to have the same audit um, program at all. Okay, so no such thing as an ordinary cat. All right, assessing audit risks. And you will literally sit down and think about those things that could go wrong. Now, there's some things that are automatic. For instance, auditing cash has risk because cash has a value to everybody. If you're gonna if you're at Boeing, no one's gonna steal an airplane. No employee's gonna steal an airplane from Boeing. Yeah, I mean, and what would you do with it if you did steal one? Well, you got a jumbo jet. What are you gonna do with it? But cash, that's at least theoretically something anybody would like to have. And so, cash, if you're auditing at Boeing, even though they have billions sitting in their inventory, there's probably it's probably not very likely that that's at too much of a risk, but cash is everything. So when you audit cash, you keep in mind that, hey, this is something everybody could use. And so the risks are going to be greater for that than say, jumbo jets. Okay, so getting an understanding of the client's business environment. So, how they operate, what their industry is, all that kind of stuff, and seeing what the problems are that could come about. And we're not going to go too far into these, but talk to management and other people. Observations is a good one. Analytical procedures, we'll do that below. Observation I found to be a really good one. I used to use this a lot because people will tell you things, and not that they're being evasive, but a lot of times people will tell you things and repeat things and all that kind of stuff, and you go and you observe it, and it's completely different. I can't tell you how many times a manager has told me, "Well, we do this, this, and this," and you observe it, and they don't do any of those things. Then you go back to the manager. You say, "Well, you said you did this. When I was watching them, they did this," and they, "Oh, really? Oh, I didn't know that." Not that they're trying to be evasive. It's just the observing is your own personal things you gathered yourself are more persuasive. Other procedures, inquiries outside the company, external sources, banks, or anything. Okay, we're not going to go too far into that. Okay, analytical procedures. These are really important. Analytical procedures. These are, you analyze relationships between data. It could be financial and non-financial. Oftentimes they're ratios. It's like you have in your finance class or any accounting classes. And plausible relationships. You're looking for relationships that you would think would be there. We'll do a thing on here, not here below. Okay, actually, I think we'll do that, and then I'll talk about a little bit more about analytical procedures. Okay, I gotta update this handout. This handout's old. 2022, 2021. That's when I was born. Okay, so let's take a look at these 2 years. We had 2022 and 2021. So 2021, the sales were 19,800. The advertising expense was 825,000. 2022, the sales jumped up to 22 million, and now they are, and the advertising expense was 610,000. What's unusual about these numbers?
That the sales went down?
The sales actually went up.
Oh, I mean, advertising expense went
Oh, yeah,
down.
yes, exactly. Yeah. You know,
They advertised less, but they still made more sales, which is unusual a little bit.
exactly. You know, how do you make more sales? Well, more advertising. And if nothing else, people, you know, if they're, especially if they're making commissions or something like that, the more they sell, the more commission they get. So this advertising expense looks odd. And so, you know, this is an analytical procedure. The plausible relationship is that, you know, there's a correlation between sales and advertising expense. The more you advertise, the more you sell. That's the plausible relationship. But when you look at something like here that goes against that, that is an indication that there's something you need to look at. And so this is, so what's unusual, sales increase. I'm going to put down underneath it, actually. I didn't give myself much room here. So what's unusual? Sales increased while advertising expense decreased. I put a D here, increased. What is a risk that might need to be investigated? There's actually two of them. So you run into this situation. What are you worried about? What's your worry if you run into this situation?
That the sales are overstated?
Very good. Sales may be overstated. Or what? And this is probably the sales being overstated is probably the most serious one. That's the one you would probably be most concerned about. What else could be going on here? It could be wrong.
Or expenses understated?
Exactly. Very good. So here's the risk that sales are overstated. They don't actually have 19 or 22 million in sales. Maybe they have something less than that because the advertising expenses are lower. Maybe it's, you know, those are overstated, or it could be the advertising expense is understated. Okay, now, is this proof of fraud?
No, it's not.
No, yeah. So these are, that's not what I wanted. Where am I at? Bring up here. I'm sorry. Give me 1 second. Analytical procedures, they're not proof. Of fraud. However, what they do is they highlight those areas that are important. They
Indicate that something may be unright, that something may be amiss.
exactly. I'm wondering, indicate actually has an N in it. Okay, indicate a risk. Exactly. So analytical procedures, they're not proof of fraud usually. They tell you where to look. They say, okay, by the way, this looks kind of strange. You know, here's something that's odd. A plausible relationship is that when sales go up, advertising expenses go up. That's not happening here. It could just be that they're more effective at advertising and it costs less and they're making more sales. I mean, it could be all lining up and up. But Analytical procedures would say, okay, here's a risk. So it's not proof, but it would indicate a risk, something that could go wrong. Now, something like 95% of all frauds are caught through analytical procedures. Put that through somewhere here. It depends on where you read about it, but some say 90, some say 99, but let's go with 95 right in the middle here. Ninety-five percent of all frauds are identified through analytical procedures. They're absolutely huge. Because of that, the AICPA requires something. Oops. I'm sorry. Requires analytical procedures for all audits. There's not too many things that they require for all audit. So the AICPA, they require it. Every single audit has to have analytical procedures. Because they're so effective. I do change this one too. So analytical procedures are very important, and they're not necessarily an indication of, it's not a proof of fraud, but it tells you where to look. And certainly you want the numbers that you need to explain will be shown there. And you'll notice that everything in the financial statements, because the balance sheet has to balance, it's very difficult. Actually, frauds can be kind of difficult to perpetrate. And a lot of times it'll come out in analytical procedures because, for instance, if I increase sales, if I say, okay, we're having a bad year, I'm just going to put some fictitious sales on the books. Okay, that's going to be a problem because of what about the inventory of that you just sold? There's a sales number and then there's a cost of goods sold number, and you're saying there's a cost of goods sold number for inventory, but you still have the inventory. So your inventory is going to be off if you put a fictitious cost of goods sold number in. If you don't put it in, that's a red flag right there. Where's the inventory that you sent out? So now, talk about the extent that people have to go to make a fraud work. You have to pretend that you sold the inventory, have a sale, decrease the inventory. You have cost of goods sold on books, and then get rid of the inventory, because when the auditors come in, if there's too much inventory, they're going to say, wait a minute, this stuff should all be sold. Why is it here? So they ship, you got to ship it out to a warehouse. So it takes a lot. It takes a lot to perpetrate a fraud, because everything is so interconnected on the financial statements. And that's why analytical procedures will catch it a lot of times, because the numbers won't make sense. Okay. Let's go down to risks. Risks come in, there's two aspects to every risk, and that is the dollar amount and the probability. So whenever you talk about a risk, you're talking about a dollar amount, what could go wrong dollar-wise, and what's the probability of it happening. Okay, so let's look at our risks here. We have risks A, B, and C. And risk A is obviously the biggest one. Please. Risk B is still up there. Risk C is pretty low. But then we have these probabilities. So what you want to do when you're doing auditing is you will actually multiply these out.
So it's 150 for the first one, 160 for the risk B, and then 4,000 for risk C.
Thank you. So it's 150, you said? Goose?
Yes.
Okay, that's 150,000 for the first one here. 160 for this one.
Yes. And then 4,000 for risks.
Okay, so the question is, well, okay, so which one of these are you probably going to be more concerned about?
I would say risk C because it has 80% of probability.
It does have the highest percentage, and it looks like it likely will be a problem.
I say B.
Yeah, probably be, you know, the dollar amount is low. This might, you know, the 4,000 may be completely immaterial. You mean, I don't know what I don't give enough information to know what we're testing here. But
If we're taking the dollar amount, if we're just concerned with the first section of it, the dollar amount, 80% of 5,000 is 4,000. So that's a big chunk of the money we're looking at and the risk that is associated with this amount, with this single amount.
yeah,
That's why I said risk C.
the highest probability is definitely risk C. But here's the problem you might have with that, though. Risk C might be something you're not even looking at because it's not material. So even though, yeah, it looks like it's likely there's a problem, the dollar amount is small. The one that you'd probably focus on in this case for doing the audit, let's take A. Let's take A and talk about this one for a second. A, big number, dollar amount 5 million, fairly unlikely. You know, there's a 97% chance that this is not going to happen. You know, so statistically, you know, in 100 years, you wind up with 3 of those. So this is a fairly uncommon thing to happen. Even though it's a big dollar amount, the risk is low. B is probably the one. This is a judgment call, but the probability is pretty good. I mean, it's not certain, but it's up there, and the dollar amount is pretty decent compared to, at least compared to the other ones. Risk B is probably the one you would look at the most. Risk C is the one that is the most likely to happen, absolutely, but it's such a small dollar amount, and especially if you're comparing accounts that you know, compared to $5 million, $5,000 error, even if it's 100% off, is probably not going to be material. So, you know, and by the way, so whenever you look at risk, you're always looking at the dollar amount and the probability. Those things that, you know, when you multiply those out, those things that are the higher value, you want to look at more, but also those things that are more likely to happen. Something that's very remote, you're probably not going to, you might do something for all of these. You might do a few other steps, but which one are you going to concentrate on? Probably going to be B. It's a fairly big amount when you multiply it out, and also there's a pretty good probability that it could happen. This is judgment, by the way, and you know, this is one of those things that you learn, and I gave you kind of a cut and dry one here, a little bit more than you usually get, because you know, you usually get, sometimes you get numbers that are they might be a lot closer to each other and all that kind of stuff. But anyway, the idea though is it's always a combination of dollar amount and probability. So a dollar amount and probability, whenever you're looking at risk, you're always looking at both of those. Things that are remote, you probably don't test as much. You know, things that are more certain. Now, if for C, if there was a reason why you might want to look at C, maybe C is some kind of a cash account, you may very well look at that one more heavily because it could indicate other things that are going on. But as far as like the purely for the dollar amount and the risk, higher the probability and the higher the dollar amount, the more risk you're going to have. And most CPA firms will kind of have a handle on how they evaluate those. And by the way, all of this would be documented. This would be if these are the risks you came up with, you document all of these and whatever you plan to do for them. You'll have something of what you're going to do. What are you going to do for risk A? What are you going to do for risk B? What are you going to do for risk C? If you identify these risks, you're also going to identify what you're going to do with them, even if what you come up with is, we're not going to do anything for C and we're going to do very little for A. You still need to document that. You don't simply eliminate something because you choose not to test it. It'll be included in your documentation. So even if C, you say, okay, it's not material, you're still going to document it, that you came up with it that was immaterial. Okay, let's move on to material. How much? Something tells me I'm not going to finish this. In fact,
Professor, can I ask you something?
sure.
So you would, once the risk is identified, like we said here, so you said we need to document them and then explain how we would go about these risks or what they indicate, or both?
Yeah, exactly. You'd identify the risk, explain why they're a risk. You come up with the dollar amount times the probability, figure out some way to judge what you have for that. And then you'll say, okay, how are we going to check for this? You'll come up with procedures. Oftentimes it'll be sampling, like classical sampling, or we're doing monetary unit sampling, to try to mitigate those risks, to say, okay, we think that this might be off by 160,000, pretty good chance of it. We go and we get comfortable that that risk doesn't exist, that that this risk that we have for this loss is not going to happen. And you document everything along the way. How'd you come up with a risk? What was the dollar amount? What did you do to test for it? If there's any change in the test, sometimes you get in the middle of a test and you realize you have to do something else. You'll document that. And you'll document everything you do will document it. Now, and again, even if it's a risk that you're not going to look at, you're going to document. We deem this risk to be immaterial. You still have to document that. You will document everything. When you guys do, sometimes they see the AI answers and the artificial intelligence answers, and they almost always say, "Well, document your findings. Document your findings." You document everything. And the CIA actually there's a CIA exam, but the CPA exam does not. They don't ask, should you document this? If they ever do, the answer is yes. They say, do you document this? Yes, you document everything. So you'll document everything that you have. And again, this comes back to that if you get dragged into court for an audit, you have to have the information there to defend yourself. Well, we did look at that. Here's our assessment of the risk or whatever. We looked at that, and here's our reasoning for what we did. But it very much is they're almost like court documents that you document every single thing you do. And by the way, this also brings me back to the idea that what you need to do must be able to be replicated by others. And if you say, okay, here's the audit procedures that we're going to do, someone else should be able to come in and do those audit procedures and get the same results. Maybe not the same judgment, of what to do with them, but they should get the same results and all that kind of stuff. So we always document everything you do all along. How did you pick the sample? How did you do it? It's all documented. So basically, you document your risks. You document the procedures that you use to mitigate those risks. How are we going to reduce these risks? And the results. What were the results of it? And then finally, once you get the results of it, you're going to have some kind of a judgment. So identify them.
Thank you.
Yeah, how are you going to test them? The results of the test, and then the judgment call. Is it, we thought it was off by this amount. Is that material? Is it not material?
Material, immaterial. Okay, thank you.
Yeah. Okay. Materiality. When we think about materiality, the one that we usually think about, this is the one that we usually think about, is the dollar amounts. So materiality, these are purely dollar amounts. For example, $6 million. This would be an example of a quantitative amount. What's material to the financial statements? It has to be at least $6 million. I gotta get room here. I'm sorry, I don't mean to mess this up. Okay. And when we think about materiality, usually we're thinking about the quantitative, the dollar amounts. So you say, okay, $6 million is material. Whatever company this is, I just made that up. But so we're only looking at dollar amounts. Qualitative says, okay, there's something besides just the dollar amounts that can cause something to become material. So, I'm sorry, I'm moving up here just to get more room. I'm going to start. So qualitative considerations. Things that would make something that is normally not material, material. This is for items that are not they could be both. But generally it's for things that are not quantitatively material. If they're quantitatively material, you're going to take care of them anyways. So things that are not quantitatively material that might still be material because of what they are, a characteristic of it. Okay, so for instance, if the immaterial misstatement the immaterial misstatement is due to upper management fraud. So even though it might be immaterial, upper management fraud is taken very seriously. And usually it is upper management fraud that it has the most red flags to it. So for instance, we say that things are material if they're $6 million. Suppose there's management fraud for 1 million. I can tell you that would definitely be material. And you say, why? You're pretty much required to rely on upper management. If they are not trustworthy, this is that integrity thing of the client. If you cannot trust what they're saying, that changes the audit completely. And so upper management fraud is different. If it's a loading dock supervisor that figures out some way to steal $1 million, that's different than if the CFO, the chief financial officer, steals $1 million. Those are two different things. The loading dock guy probably has nothing to do with the financial statements, and however they did it, he did it. It's of interest, but if it's $1 million and our materiality is 6 million, it's not material dollar wise. If it's a loading dock supervisor, you probably don't do anything with it. Obviously, you turn it over to management and the board of directors, let them know about it, but you're not going to have it in your financials. You're not going to do anything with it in the audit. If it's upper management, the chief financial officer you find is embezzling $1 million. That changes it completely because of who it is. They're people that you need to trust. They're people that make the financial statements, and all of a sudden you cannot trust these people. So if there's upper management fraud, it can be qualitatively material. If it violates a contract, I'm going to change this for a second. I'm going to try to simplify this a little bit. This will be better. So upper management fraud, violation of a contract. So even though it's not material, if it violates a contract, then it very well could be material. Because notice that whoever is the other party to that contract, they will be reading the financial statements and relying on those to see whether the contract's being followed. So for instance, a lot of times for smaller mid-range companies, when they go, if they get a loan from a bank, the bank says, okay, we'll give you the loan, but you have to get all your loans from us. You can't be getting loans from all over the place. You can only do financing through us. That's a very common thing. And again, they don't want you collecting a bunch of loans from a bunch of different institutions, and all of a sudden it collapses, and they're standing in line, with 10 other banks. So they say, okay, we'll give you this loan. However, all your financing has to be through us. Well, if the client is getting financing from somebody else, it violates the contract, even if it's not material. Maybe they got a $200,000 loan from somebody, and it's less than the 6 million. If it violates a contract, that $200,000 loan from a different bank violates the contract, then it's material. And you will read those banking documents to see if it does violate, because almost all of them have something like that. They try to protect themselves, obviously. So if it violates a contract, it could be very much be a qualitatively material item. If it reverses a trend, or changes a net loss, into net income. So it could be material if it reverses a trend or changes a net loss into net income. So if it changes your perception, the perception is, if you're talking about this one, okay, let's say that you have a small loss and they cook the numbers to come up with a little bit of net income. Okay, it's not material, but instead of a $100,000 loss, they have a $200,000 net income. Less than the 6 million. That could be significant because if the investor's mind, a company that's losing money is different than the company that's making money, right? Even if it's a small amount that they're making, it's better than losing money. So a company that's losing money is viewed from the investor standpoint as a different company. And usually it's when they change a loss into income. As odd as it sounds, you would say, okay, well, if they have income and they change it to a loss, can that happen? Yeah. Why would a company do that? Why would a company change? This camera is still crooked. Something's wrong here. why would a company want to change? You know, let's say they're profitable. Why would they want to make it look like they're not?
For instance, when they are trying to get a loan for equipment, let's say, they want to show net income instead of net loss.
That's true.
Look good for investors
Yep. Yeah. And Andrew, yeah, exactly.
and all the shareholders. Yeah.
For tax purposes. But if they're trying to make it a company, let's say my company's profitable, I don't want it to be profitable. I want it to show a loss. A couple things. The most obvious one is for taxes. You know, if you're losing money, there's no, you know, you avoid taxes. So there are companies that, especially smaller companies, not usually publicly traded companies, but smaller companies oftentimes, you know, it's an incentive for them not to show income. So yeah, if it's for tax purposes, they don't. It could also be other things too. If there's someone trying to buy out a company and they want to reduce the price. So let's say that I'm the, you know, the president of the company and I want to buy the company outright. If I can make it look unprofitable, I can make it look, you know, I can get it at a cheaper price. So there are reasons why you still have to pay attention to the other ones. Now, for the general public, rarely do you get called into court for a company being stronger than they say they are. You know, a bank would have really no case to say, well, wait a minute, this company, you know, you said this company was, you know, you said they were unprofitable, they actually were profitable. Okay, well, you based your loans on them being unprofitable, so you know, you probably charge them a higher interest rate and you have no complaints because you just charge somebody who should get a lower rate, a higher rate, and you know, you should be happy. So it's very difficult to a lot of times to get sued for if a company shows less income than if they show more income. But it can happen, and there are reasons. Taxes are probably the most common one, and then also, you know, like I say, if someone's trying to buy it and trying to make a company look like it's less profitable so they can get it at a better deal or something, that can also play into it. Okay, so violation of contract reverses a trend. Those are probably those are the most common ones, and almost everything else is a kind of a theme on that. But certainly those are things that you want to look out for. And again, even though the dollar amounts could be immaterial, they might still be material because of their characteristic of what they do. Violation of a contract, reversing a trend, upper management fraud. I'm going to throw this in here. It is actually we covered in the upper management fraud. I'll put this one in. If it increases management compensation. That's another one that would be in there. And so if it increases, you know, they goose the numbers a little bit to increase their payout. That would almost be covered in this one, upper management fraud, but anyway. So if it increases compensation, maybe they don't get their bonus if they don't make income, so they change the numbers a little bit to get more income. Okay, let's stop here. Yeah, we'll stop here. This is going to be a long chapter, and I apologize for that. I've been trying to cut this down for years, but yeah, so let's stop here and let's take a break. And we come back, we'll start in on monetary unit sampling. Seven oh two, 712. Okay. Okay, so last time we ended up calculating the sample size, and from the sample size, we would get the sampling interval. You know, we fit it up over. If you recall from last time, I'm telling you this. You know, if you have $5,000 worth of stuff and you break it up into however many items you're going to pick, and these are the intervals. And so the sample size determines how big these are. You know, here you have 5,000. If this was 10 items, right, these would all be what, $500 each? You know, so it makes a difference. The interval is based on how many items you have compared to the book value. So that's kind of what we're looking at when we're doing these. And there's some formulas you go through, but even though it's kind of a pain here, in real life, this is a huge time saver. This is the fastest sample you'll ever pick. Okay, so here's the formula. And we can get the things that we know right up front in there. How did I do it last time? Yellow or I didn't do anything. Okay. Well, that lowers the bar. Okay, so we can plug these numbers in. So total book value, population book value is this. Let's bold it. The tolerableness statement so this is basically material. What's material? Oops, let's try that again. So, you know, what would we call a material misstatement? Well, in this case, it'd be 60,000. You know, this is, so the tolerable misstatement is 60,000. Anything over that, we do something about it. The expected misstatement is always going to be lower than the tolerable. Usually much lower. It could be 0. Okay, so these are the numbers that we got. Now we have to go to our tables. Green. Okay, so our risk of incorrect acceptance is 10. So this is if we accept the financial statements, and we shouldn't. The lower the better on this, but there's a judgment call. So 10. Okay, so that'll be 10, and we are going to look for our reliability factor at 0 and our expansion factor. So we need to go grab two numbers based on 10%. So we need the reliability factor, and then we need the expansion factor. All right, so, oh, I know what I can do. I can color coordinate all these. See, I'm living what I'm telling you guys about color coordinating things. Okay, so we're going to go get our factors that we need. All right, so we go down to our table, and we're at 10%. It's at 0, and that's just the formula. Row 0 is used for sample size. I don't know if we get the basic percent today or not, but anyway, so 10%. This is our reliability factor, 2.31. Maybe I should do the spacing of this. Okay, so I'm going to put this in here. And our expansion factor. Expansion factors are easier because there's only one number. 10%, 1.5. There's no row 1, 2, 3, 4, blah, blah, blah. Okay, now notice that I think I told you guys this before, but you're probably going to want to do this first on the bottom one. Okay, so what's that? Hey, where's my code is over there? All right, my batched up calculator here. And 2,000,000. Scratch that. 5,000,000. I'm just going to write it in here. 5,775,000. All right, now we're going to multiply this first. So 6,000 times 1.5, what is that, 9? So 60,000 minus 9 is 51,000. Thank you. Why these are showing up little? They're showing up as little numbers. All right, so this will give us our number of items we have to pick.
113. It's actually 113.24, but if we round it up, it's gonna be 113.
Yep, very good. Yeah, so this is a number, and yeah, I'm going to say 113. I put it in parentheses that, yeah, it's, oops, don't do that. You round it off to the nearest. Okay, so we have 113 items in the sample. Our book value is 2.5 million. We're going to divide it by why are these so small? Okay, whatever that is. So 22,124.
Yes.
I just rounded off to the nearest dollar. Let's try that again. We'll put it in the right box this time. So this will be our sampling interval. So we're going to take 113,000. No, we're not. 113 items. And we're going to find the first item that passes the cumulative total of 22,124. The next one would cross 44,000, whatever, 248, something like that, whatever it is. So every 22,124, we will pick an item. And notice that if there's an item for more than 22,124, it's 100% guaranteed it'll get caught. So if they are cooking the books and they increase any given item to larger than the interval, the gig is up. We're going to catch it. And again, so there is a real, that's not me. Oh yeah, so on this one, so this would be the 22,000, the interval here would be 22,124, and instead of 5, we'd have 113 of them. Okay, so so the beauty of this thing is it's very quick to get the sample size, which is not the case for classical sampling. Classical sampling, because it is fairly complex, to my knowledge, they've never asked you to calculate the sample size for classical sampling. They have done for monetary unit sampling. What would be the sample size for this? But they've never done it for classical sampling as far as I know. And the reason is because it really is kind of a pain, and you have to get a pre-sample somehow of the standard deviation before you can do it. So to get your sample size, you have to take a sample. It's a lot of work to find a sample size for a classical sampling one, whereas this one is much easier. Oh, and also, maybe even more importantly, this thing picks your sample for you. There's no going to a table, random number table. Okay, we're going to use the first 2 rows or the first 3 columns or whatever it is. Whenever one crosses the interval, that's what you pick. Bigger items are more likely to be picked because they have more dollars in them, and each dollar has the same probability of being picked. But larger items will have more of them, so they have a higher probability of being picked. Even if they don't go past the interval, they have a higher percentage of being picked. If they go past the interval, it's 100% sure. Okay, any question on that? So find the sample size. Well, it is a little bit convoluted. It's also much easier in working it. I'll show you something else though too. If you don't have any expected misstatements, and oftentimes using this method, they'll use it on accounts that don't have an expected misstatement. Notice if this goes to 0, you don't need any of this. You don't need the expansion table. If your expected misstatement is 0, and like say a lot of times in sampling it will be, this will go to 0. You won't have this expansion amount. You won't need this table at all down here if you don't have any expected misstatement. But if it's 0, 0 times anything to be 0. Okay, a question on that? So this is actually a very convenient method to use in a lot of ways. Picks a sample, it's easy to find the units, items that you need, and it picks your sample for you. Okay. Now, I told you all the great things. Now for the wacky things. Basic rules for monetary time. Okay, so we'll see how this plays out. I don't know if we get. We'll see what we get on it. Incremental allowance is additional sampling error that has occurred for misstatements detected through the sample volume. Okay, so incremental allowance. This means that there is more. It basically means this. If you do find errors, that means that more errors are likely, right? You know, if you don't find any errors, then errors occurring are unlikely. But if an error does occur, you find an error. Now it changes because now it opens up the possibility that there could be more of them. If you never had one, the likelihood of it happening is probably less than if you do have something. You go, okay, we don't know that the probability of having errors just increased because we found one or two or whatever it is. So the more errors you have, the higher, the more money you're going to set aside for the possibility of problems. Monetary unit sampling is only used for overstatements. Understatements are ignored. And this one really bugs, well, it bugs me. I think it bugs auditors in general and maybe accountants too, that you can find a misstatement that you just ignore if it's an understatement. You know, and again, that's, you know, when you find something that's wrong and you go, okay, well, this is wrong here, you know, you ignore it. What do you mean ignore it? It's wrong. You got to ignore it. It's this method. If you do find understatements, it's not supposed to find those. It ignores them. Says there's no problem here. You know, you just ignore it. And if the misstated item has a book value that is equal to or larger than the interval, then you use the actual misstatement. And there's a reason why we do that. Okay. So if you find an item that is bigger than the interval, and this is, for instance, if you find fraud or something like that, you have an item that's bigger than the interval, it's 100% sure it's going to get caught. But at that point, you don't do the same thing we do, the kind of ratio estimation thing. You simply take whatever the actual misstatement is. And I'll kind of show you why we do that in a second. But so if it does cover the entire interval, we use the actual misstatement. Okay, let's see how this thing works. Explaining it sometimes this stuff. Okay. The first three are pretty much well behaved. The audit value is less than the book value. So these are overstatements, right? This is an overstatement. So we'll take 14,000 divided by 20,000 times 40,000 equals a projected value of some number.
$28,000.
Yep. So our projected value is 28,000 here. And so our projected misstatement is how much?
$8,000.
Yeah. So we're saying the interval is 40,000. We're saying that it really is worth 28,000. So the misstatement will be 12,000.
Excuse me, why is it 12,000?
Because the interval is 40 and the projected value is 28. So we're saying that this interval,
Oh, okay.
yeah, so 12,000 of it isn't there. Of the value isn't there. And again, we're picking one item and saying it represents the entire interval. So this one item represents the entire interval. Okay, this one. 2,400 divided by 3,000.
$32,000 projected value,
Okay, so
so
30,
8,000 projected misstatement.
yep. Yeah, so the 40,000 here, we're saying that it's really only worth 32, and so this is a projected misstatement. And these, by the way, are all overstatements. All these are overstatements. Now, this one, you'll see different literature talk about this different ways, but if you have something in their books that they say is worth 1,700 and it's really worth 0, occasionally you'll see in the textbooks, they'll say, they'll say, okay, if it shows up as 0 and, they have some amount on the books and it shows up as 0, you should investigate as to why. You do that on all of them. You investigate as to why they are misstated. That's not anything different, but regardless, if it does come out that it's 0 and they have it on the books in this case for 1,700, that means that the whole thing is misstated. So 0 times 40,000 means that this projected value is 0. Okay, now, so these first three are kind of well-behaved items in our sample. We do a ratio on them. We figure out what the projected misstatement is based on that ratio. Now, we go to number 4. Number 4 has actually got a problem. What is it? What's odd about number 4?
That the book value is less than the audit value, so that means this account is understated.
Yep. This is an understatement.
And then the projected value is 54,737 when we round this up.
Actually, it's going to be 0.
0. Okay.
No, I'm wrong. I'm lying again.
Yeah.
It's 40,000. I'll show you why. It's actually up here. Understatements are ignored.
Wow.
Yeah, and yeah, that does bother you. I mean, or it bothers me. Anyway.
Yeah, I mean, just like being an accountant, like every little number counts, you know what I mean?
Yeah, no, I
So
agree. For this,
just
if it is a understatement, you ignore it.
okay.
Now,
Let me
it doesn't
check
count against
that.
it.
Yeah.
And so, yeah, this is an odd duck. So it's not supposed to find these. It's kind of like if you go fishing and you catch an old boot or something like that, you're not trying to find old boots, so you throw it back. Well, don't throw it back in the water, throw it in the garbage can. But the idea is that's not what you're looking for, so you throw it back or throw it out. And so this is only for overstatements. If you find an understatement, you ignore it. And yeah, it does feel strange to do that. So if you're going to ignore this. And you probably wouldn't even list this as an exception. Take it out completely, but I'll leave it. Leave it in. So this is So these are the predicaments. Okay, now coming down here, we get into the wacky ones. Two more wacky ones. Now, here we have a book value that is 44,000. So they have this list on their books at 44,000. What is significant about that?
That is more than our interval?
Yep.
No, that's not it.
Yeah, yeah. It's more than it. This is 100% sure of being picked. And this is, by the way, if you're doing this method, this is exactly why you're doing it. Here they have an account that's really worth 11,000, and they bumped it up to 44,000. When they went over 30,000, it's 100% sure this item is going to get picked. Okay, so this item will be picked 100% of the time. Don't do what I'm going to do right now. I'm going to show you something different, but if we were to multiply this out, this would come out to 10,000, and this would come out to 30. Don't put these in. Don't put these in. We're not going to do it this way. We're going to use the actual amount. Merge. Okay. So coming down here, we're going to take the actual amount that it is off by. This says on their books they have the book amount is 44,000. The audit amount is 11. So, oops. The actual misstatement is 33,000. That's what you're going to use. If the book value is higher than the interval, you are not going to do any of this here. You're simply going to put in 33,000. You put what the actual amount is it's off by. And notice that the actual amount is more than the, if you were to calculate it out into the estimated. If you put that in at 30,000, well, you know that this account in reality is off by 33,000. It's actually off by 30. This is the actual amount that it's off by. It's 33,000. So if you do run into this situation, we use the actual in this statement, not the estimated. And the same thing would go through is true down here. Now this one would actually cross two intervals at least. It could be three, but certainly it would cross two intervals. And we'll do the same thing down here. Don't do what I just did. Let's try that again. Okay, let's. Okay, so let's see, the book value is 90,000 on this one. The audit amount is 65,000. So the actual misstatement is, what is that? 25,000? I'm gonna check that. Yeah, I think it's 25,000. So this will be 25,000. Okay, so let's take a look here. So let's finish this up. So our total projected value, adding all these together. $60. Let's see. So 60 and 58 is what? 118? Just the calculator just to make sure. Yeah, you guys got 118 for these? Oops. You guys being quiet because I got the wrong number up there?
Yes, it's 118.
118, okay. So 118, we have a book value of 800,000. Now, we're saying it's overstated. So what is the projected value of this?
$682,000.
Yes. So this would be our projected value. And this would be our total overstated. Okay, I'm going to go through the incremental analysis. I think we're going to call it we'll call it a day after this one. There's no way we're going to get through this one. These take about, I don't know, half hour, 45 minutes to go through. All right, so incremental allowance. Incremental allowance means that there could be more things wrong in the interval. So there could be more things wrong in the interval. Now notice for this first one, the book value is 20,000. The interval is 40,000. So there's still some other things in this interval that could go wrong. Right? I mean, we have evidence that an error can occur in that interval. And there's still more room in that interval for other items that could be wrong. So there's an incremental allowance, and we will include this in that incremental allowance. Because more things could go wrong in there. We'll see how this works out next time. And same thing for this one. Our book value is 3,000. The interval is 40,000. So there's another, what, 37,000 worth of stuff. And there could be other things wrong in that interval. If we found an error, that means there could be other things that are wrong in there. So this is also a yes. And this one, we use 1,700, so the other, what, 38,300 could go wrong. So we will set aside some, what they call it, incremental allowance for that one. It could be worse. Number 4 isn't wrong at all. There is no incremental allowance. There's no error here. Which, again, yes, it bothers us, but yeah. So this one you wouldn't even include, most likely, if you were writing this up, but you might include it just for yucks. But the incremental allowance does not apply. There is no problem with this one. The projected misstatement is 0. There's no problem with it. Down here, notice that these cover the entire interval. There's nothing left in the interval to go wrong. It covers the entire interval. So even though we do have misstatements here, they are not included in the incremental allowance. Nothing else in that interval could go wrong. So, the two kind of wacky ones here are understatements are ignored completely. If the item is more than the interval, we use the actual amount and it does not go in the incremental allowance because nothing else in that interval could be misstated. It covers the entire interval. Question on that? I know it's kind of goofy, but that's kind of what it is. It's and still, I must say that this is a much easier than classical sample, even with these quirkies to it. But down here though, this is exactly why we do it. And you have somebody that takes an $11,000 account and bumps it up to 44,000. They just guarantee they're going to get caught. Okay, we will. Oh, I know one more thing. Never mind. I was going to ask you what the sample size of the items is. It's already given to you. So sample size 800,000 divided by 20 items. That's how we got the interval. Okay, let's stop here. And nothing to turn in this week.
Just the Medtrans case, right?
Oh, was that this week or last week? Let me take a look. You're right. Yeah, the Medtrans case is due Friday. Yeah. So yeah, you're right. Okay, any questions? No. All right. So yeah, turn the transcation if you don't excuse me, if you don't have it turned in already. And I'll see you next week. And we should finish up. I'll tell you what, we're gonna finish up one of these two next week. We'll figure out which one it is next week. But we're either gonna finish up the monetary unit sampling, or we're gonna finish up the handout. I think I'm leaning towards finishing up the 5 and the 5 and 6 handout. So next week, hopefully, we'll finish that up. Any questions? All right. Have a good week. We'll see you guys.
Thank you, Professor. Good night.
Good night, guys.
Good night.